All right, we are looking at futures down again on U.S.-China sentiment. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, trade tensions flare up yet again. China and the U.S. accuse each other of violating the recent agreement. Plus, another twist in Trump's tariff agenda. The president pledges to double tariffs on all steel and aluminum imports, and an M&A Monday. We kick off the week with two big pharma deals as companies battle for market share. Katie, this is your wheelhouse.
It is. And
one of your wheelhouses.
Let me tell you about these deals. We have Bristol Myers paying Biontech $11 billion to license its next generation cancer drug. You also have Sanofi buying U.S.-based Blueprint medicines in a $9 billion deal. Look at some of the numbers behind me. Biontech up about 13%. Blueprint absolutely soaring right now. And then not in deal news, but in the health industry, we're also taking a look at Moderna winning FDA approval for a new COVID vaccine for a narrow group of people under new HHS leadership, but still approval nonetheless, and Moderna shares up a needed 3.7% pre-market.
Yes, so massively important work, pretty important work, and for a smaller slice of the people, it's
your
okay.
opinion.
Aluminum and steel stocks are moving bigly after President Trump said he would double the tariffs on those metals to 50% from 25% in an effort to aid the Japanese Nippon Steel purchase of U.S. Steel shares. You can see, well, U.S. Steel itself already had the rally last week. Nucor up 12% and Cleveland-Cliffs gaining 27, Katie.
Which we will get to. But, Matt, as you mentioned at the top, you have U.S.-China tensions again weighing on investor sentiment after President Donald Trump accused China of violating the latest trade deal. Now you have China, on the other hand, also accusing the U.S. of violating the trade agreement by introducing new chip restrictions and targeting Chinese student visas. Here's Treasury Secretary Scott Bessent over the weekend.
That when President Trump and Party Chairman Xi have a call, that this will be ironed out. So, but the fact that they are withholding some of the products that they agreed to release during our agreement, maybe it's a glitch in the Chinese system, maybe it's intentional. We'll see after the president speaks with Party Chairman.
Let's bring in Bloomberg Washington correspondent Tyler Kendall at the White House. And Tyler, we also heard advisor Kevin Hassett say that President Trump is going to speak with Xi Jinping this week. How solid does that prediction look?
Yeah, hey, Matt. Well, this recent escalation of tensions really does throw a wrench in it, although I can say I just caught up with the Deputy Treasury Secretary Michael Falkender here at the White House, who told me that eventually this is going to have to come to both leaders getting on the phone to talk about a way forward here, because we're starting to see some cracks in the agreement that was reached in Geneva, with both sides accusing each other of violating it. On one side, you have, of course, China saying in a new statement out from its Commerce Ministry this morning, really rebuking the White House when it comes to their concerns about AI chip controls, as well as plans to revoke Chinese student visas. But the other end of this, ahead of that, was the U.S. accusing China of basically slow-walking the export of critical and rare earth minerals. Falkender did add to me that they did have discussions over the weekend with Beijing about this, to, as he called it, unlock these exports. We have to keep in mind, of course, these are critical minerals that are very important to these essential supply chains, as you all know, from the defense industry to autos to chips. Actually, in fact, Matt, China controls the production of about 30 out of 50 critical minerals to the U.S. That's considered to be just a huge number. And Bloomberg Economics says that as Beijing wields this weapon, even if it's not at maximum capacity, it still has such great power to inflict pain on the United States going forward.
And Tyler, when it comes to this potential call that it seems that the U.S. is asking for between President Donald Trump and President Xi Jinping of China, isn't this not what China wants to do? Wasn't one of the asks of the Chinese administration that they want a delegation from the U.S. to be handling the negotiations, not the two leaders necessarily talking to each other?
Right, exactly, Katie. This has long been one of those points for China. Our reporting, a few months ago was that they wanted a point person other than President Trump to lead these negotiations. It appears that they were able to get that with Treasury Secretary Scott Bessent, but then you have the top advisors to this White House saying that President Trump still will be directly involved in these negotiations. President Trump himself saying that he does want to ultimately get on the phone. We're going to have to see how this ends up shaking out here, because there are still a lot of different pressure points and issues as these tensions do escalate. And keep in mind, one of those deliverables that came from the Geneva Agreement was that they established a mechanism to keep talking with each other to try to prevent something like what we're currently seeing happening, these tensions escalate. So we're going to have to see if they can resolve this anytime soon.
All right, Bloomberg's Tyler Kendall, appreciate your reporting, joining us from D.C. And another decision from President Trump is having a major impact on steel stocks. The president said he would double tariffs on steel and aluminum to 50% from 25%. Here with more, I'm thrilled to say we have our commodities queen, Alex Steele. She's also co-host of The Close, coming in early for us. Alex, great to see you. It seems like there's a bit of a pair trade going on this morning, which is long steel stocks and maybe short some autos here.
Oh, and definitely short overseas stocks as well. You saw BMO Capital Markets downgrading Algoma Steel. It's a Canadian steel company. And the reason why is the U.S. imported, as of last year, 26.2 million metric tons of steel. That's a lot. Now, if you just sort of factor out broadly, maybe the U.S. produced around 20 million net tons. So there is a gap that needs to be filled. And guess what? A lot of that goes to from Brazil, Canada, Mexico, and South Korea, for example. And in any industry that clearly is going to use steel, Matt's industry, cars, my industry, oil, it is going to be hurt by this. Your input costs are going to rise.
Yeah, so President Trump doing this to protect U.S. steel as Nippon Steel buys it. Am I getting this correct? Because I can't get anyone to tell me a straight story.
We have no idea what Nippon Steel is doing. We have no idea what this golden deal is either. So we have no idea if it's an investment, if it's a buyout, and if the government's really going to have say in it. So that's number one. Number two is that it's not just necessarily about steel, for example. It's going to be about the other commodities, critical minerals and copper as well. So if the administration did this with steel and upped it to 50%, now the expectation among analysts with Citi is that we're going to see that with copper. We're going to see it with most minerals. And that's going to sort of across the board. Like, do you know how much steel and copper is used in a car? No, I mean, off the top of my head, no, but it's going to be a lot, right? So that's going to wind up hurting all of that. And domestic prices are going to have to rise a lot to offset those tariffs, to make those tariffs overseas worth it to buy. So you're going to have a huge rise and a discrepancy all over the world between these two metal prices.
Alex Steele with the latest on steel. Great to get your reporting and your insight there. That is Bloomberg's Alex Steele. You can catch her on The Close, but don't go anywhere because we're going to turn to pharma right now. Bristol Myers will pay Biontech as much as $11.1 billion to license a next-generation cancer drug. For more, I'm pleased to say we're joined by Bloomberg health reporter Damien Garde. And Damien, it seems like cancer is one of the sole hot areas to do deals right now.
It does. In fact, I think that reflects both that the pace of new developments in cancer has been faster than many other disciplines in science, but also on the business side, that is just one of the safer places to invest for these pharmaceutical companies that are facing so many headwinds, but among them drug pricing challenges. And cancer medicines have generally been reimbursed and covered at a much higher rate than other clinical categories. I think that partially drives what we're seeing.
So a lot of these medicines seem to come from China. What's the treatment BNT 327, which was licensed from a Chinese company by Biontech. Then they bought the Chinese company. Now Bristol Myers Squibb is going to use it. What's the story with the Chinese biotechs doing so well on cancer?
It's kind of fascinating. So as you mentioned, this medicine comes from China, and all of the medicines like it that have the similar target that this pursues to treat cancer have all originated in China. One that's partnered with an American biotech company, another that went to Merck, and another that was licensed by Pfizer. So this is an interesting kind of sea change in the United States' relationship with China in terms of new medicines. For years, it has been perceived as China is a place where you can go get kind of a Me Too molecule that works similarly to something developed in the West, but that might be cheaper by virtue of it coming from China. In this instance, China is leading the drive here. These medicines were invented in China, and there are not, by and large, American equivalents of them.
We have to talk about one of the other big news items coming out of the health industry today, and that is Sanofi. It's a French drug maker buying Blueprint, which is U.S. based. And what stuck out to me was that you had the CEO of Sanofi, Paul Hudson, saying that they still retain a sizable capacity for further acquisitions. And that's after this deal, which is for at least $9.1 billion.
Yeah, I think part of the reverberations of this news is that things have not been going well in the biotech industry by and large. As I mentioned, the headwinds they face, not only out of Washington, but more broadly with macro stuff. So to see a deal like this, where a company is paid, it's not a huge premium, I think it's 27%, but still, a deal getting done of this magnitude in 2025 is good news for the entire biotech sector, which has been fairly beaten down. And M&A just really hasn't been there this year, despite the fact that with depressed valuations, you would assume that the likes of Sanofi or Bristol Myers would be out shopping, but we haven't seen that as much, and so this is definitely good news for sentiment.
Absolutely, and you can see Blueprint shares up 26% pre-market. I believe that deal price was about a 27% premium to Friday's close. So there you have it. Health reporter Damian Garda, great to see you. Let's take a quick check on these markets. Matt, it is notable that today will be the first trading day of the second half of the year. We said goodbye to a May where the S&P 500 rose 6.2%. We're on a little bit of a downdraft this morning, maybe as a result. You can see the S&P 500 down about 0.4%. And then you have the NASDAQ 100 down a little bit. The Russell 2000 pretty much unchanged at the moment.
We still watch that, huh?
We still
have
do.
the Russell 2000 up there, which is fascinating.
We have to keep an eye on these domestically focused small caps.
Yeah, so it is traditionally one of the slowest moving months, June,
yes,
right? As Wall Street sort of decamps to the Hamptons.
We still look at seasonality?
Yeah, SEAG. Go.
Yeah.
On any index. It even works on the less significant indexes.
I'm just saying that because sell in May did not work.
No, it was a bad plan this time. Let's talk about, when we come back, new street high price target for Boeing. This is a story that Katie has been following for years. This iconic plane maker, thanks to its status as President Trump's trade lever, some analysts like it even more. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Russia and Ukraine are resuming direct peace talks in Istanbul a day after Ukraine staged one of its boldest aerial attacks inside the Russian borders, which destroyed long-range bombers and other aircraft. The meeting marks only the second time the two sides have held public negotiations since the early days of the conflict. Prospects for peace, though, remain distant despite months of high-profile efforts from the Trump administration. The president has grown increasingly frustrated with the lack of progress. Zelensky says the talks have just ended. And Tesla sales have plunged 67% to an almost 3-year low in France. That's despite the company rolling out a redesigned version of its most popular vehicle, the Model Y. The news undercuts CEO Elon Musk's assertion that the car maker has recovered from its sales slump, at least in France. Last month, Musk told Bloomberg News the company had already turned around. And Delta CEO Ed Bastian says he's more confident about demand in the second half of the year after U.S. passengers cut back on travel spending in recent months. He spoke in an exclusive interview with Bloomberg in New Delhi over the weekend.
I think in the U.S. structure, lower ticket prices is part of the reason we're seeing lower prices as costs have come down. It's helping to insulate the fall off that we've seen from expectations on demand. Year over year, though, demand hasn't fallen. Demand's pretty flat to, and I expect in the second half of the year, it hopefully will tick up a bit.
For more on aviation, we're joined now by Bloomberg's Benedict Camel, who leads our global aviation coverage. So Ed Bastian was speaking to Bloomberg, along with many other airline executives at the IATA AGM in New Delhi. And reading and listening to some of these comments, these executives seem pretty sanguine versus the earnings season that we got through a couple weeks ago, where you had airlines pulling their outlooks or giving different forecasts based on different scenarios. Did all that much change in the last 2 or 3 weeks?
Well, the only thing that might have changed by now is that people have started getting used to the situation that they're in, which is the sort of up and down, the in and out in terms of the tariffs. But tariffs, make no mistake, remain very much the top theme, and the fallout from tariffs at the IATA AGM. We spoke to Ed Bassman, we spoke to Larry Culp, the head of GE, and these are all companies that are feeling the effect. GE are feeling it in terms of the price of their products. They have to hand some of those additional costs onto their suppliers, onto airlines. But airlines like Delta from that we just heard from, or Virgin Atlantic, or Air France, all of these airlines are saying, we've been through a pretty rough patch. The good news is it's holding up in the front of the cabin. That's where the real money is made. So the business class end of the cabin, that's still relatively stable. It's at the back end, the more price-sensitive people, that's where things are a little bit patchy or choppy, as Ed Bastian called it. But they have some hope that coming into summer, going into the latter part of the year, people will have moved on from this and will start booking again.
Benny, I got to ask about Boeing. As a trade tool, Bank of America has raised its rating on the shares to a buy from a neutral because President Trump seems to be using Boeing to negotiate deals with other countries, kind of enticing other countries to buy more planes. On the other hand, President Trump himself doesn't seem terribly thrilled with Boeing. Listen to what he had to say on Friday.
Well, it's here already. Yeah. It's in the country. It's being refitted for military standard.
How much will it cost to refit it?
Oh, I don't know. Whatever it is, a hell of a lot less than building a new one. We're waiting too long from Boeing. Boeing has got to get its act together.
All right, so I could have prefaced that better by pointing out he was going to be talking about his new, to him, used jet from Qatar. But the point being, he doesn't seem terribly thrilled with Boeing.
Yeah, this is sort of a love-hate relationship that's been going on for a while. Boeing, on the one hand, is a national champion, is sort of the national champion. They are the biggest exporter. They make visible, big made-in-America products, only made in the US. All the aircraft that Boeing sells are made at home. They have a huge sort of trade surplus as a result in terms of aviation products. So in some sense, they should be a national champion that they should protect, the government that is. On the other hand, as we just heard, they are not getting the plane that Trump really wants, which is the Air Force One jet, to him on time, which is why we got into this whole hot mess on the Qatari plane. But the bottom line is he can use Boeing products as a diplomatic tool. We saw it in the Middle East, where he got a massive deal out of Qatar Airways. We'll probably see more of those going forward. So as long as he can sort of wield Boeing as a tool to get favors and sort of go either way, then it's actually something that's quite good for Boeing. We'll probably see more deals going forward. We have the Paris Air Show in about 2 weeks. That's traditional a venue where Airbus reigns supreme, but you should expect Boeing to walk away with some deals there. We might get more out of the Middle East. We're hearing some companies are still in buying mode. So they're not done yet, and that will be good news for Boeing, which is why you're seeing these upgrades.
Got it. Benny, thanks so much for joining us. Bloomberg's Benedict Campbell leads our global aviation coverage out of Berlin. And Katie, you've been pretty excited about Boeing for at least, I'm going to say at least a year, as long as this show's been
a year. As long as we have been talking intensely every single day. I'm interested in Boeing just because it feels like one of those things that are too big to fail. How could the U.S. government let Boeing fail? We're obviously not anywhere close to that.
It feels almost like a state-owned company.
A little bit. You could make that argument. I wanted to take a look at Boeing shares year to date because they're up 17% on a total return basis. You compare that to the S&P 500, which is pretty much flat. Of course, the obvious pushback is that you just zoom out a little bit. Boeing falling 32% in 2024. But still, the rebound year to date is remarkable.
I mean, I pull out 5 years. I always default to that because of the comp function on the Bloomberg. And they're up double that over 5 years, so 35%. The interesting thing is that you see a bigger drop. Sorry, I have Air France. I put Air France here.
Air France. You meant Airbus.
I meant Airbus, yes. If you look at Airbus over the same period, it's up 172%.
Yeah.
So they're doing a little bit better. There's two plane makers essentially in the world. And Airbus is crushing it.
Yeah, it was pretty funny. Last year, the pair trade was Boeing short Boeing, long Airbus, because Airbus rose about 10%. But we'll continue to track Boeing, whether or not Matt likes it, because I think it's fascinating.
I just love talking to my buddy Benedict Camel, and I wish we could get Guy Johnson on this show. That would be a real coup if we could book him.
He's booked. He's busy.
Yeah. Coming up, RBC just raised its S&P target. Will Citi's Stuart Kaiser do the same? We'll put him on the spot and ask him that question live on internationally broadcast television. This is Open Interest. We are moments away from the first day of trading in the month of June. This is Bloomberg Open Interest. I'm Matt Miller. Looks like we're going to kick it off on a negative note, a little bit of a drop in futures. Not too bad, 0.3% on S&P futures, 0.5% on NASDAQ futures. After the U.S.-China trade war kind of reignites and Donald Trump doubles tariffs on steel and aluminum, that's pretty good considering. Take a look at the opening bell at the New York Stock Exchange. That guy's super psyched. Diamond Rock Hospitality celebrating their 20-year anniversary. They've been listed for 20 years, and the stock is up 32%. I feel like they can do better. Down at the NASDAQ, you have Charles River Associates. They're celebrating 60 years. I didn't go that far back, but over the last 4, they're up 400%. So they are absolutely crushing it. And I guess signing the opening bell at the NASDAQ. Katie's looking at some stocks that are moving pretty big on those tariffs I mentioned. What do you got?
Absolutely. Let me tell you about them. We're keeping an eye on aluminum and steel stocks, of course. They're moving mostly to the upside after Trump said he would double the tariffs on those metals to 50%. That is in an effort to aid the Nippon U.S. Steel deal, according to the president. Let's take a look at the fallout right here. You have U.S. Steel actually down a little bit right now. That has some idiosyncratic factors going on. So you take a look at Nucor and Cleveland-Cliffs, both up in a big way. Nucor, 11%. Cleveland-Cliffs, even better, Matt, soaring right now, up 23% at the open.
All right, let's get to that's the steel news, and there are a lot of moves there, but also, and bigger, moves in healthcare. Bristol Myers Squibb is going to pay Biontech $11 billion to license its next generation cancer drug. Sanofi is buying U.S.-based Blueprint Medicines in a $9 billion deal. That's also an immunology company. And then Moderna is doing something with COVID. We are back with, wait, that was it? We're not going to...
That was it.
I thought, oh, okay. I thought it was introing. We're going to get to...
Don't worry, it's coming up.
We'll get to Sam Fazeli in a little bit out of our Chicago bureau. We're back, though, with Citi head of U.S. equity trading strategy, Stuart Kaiser. So I guess we're talking about a couple of sectors here, which gives me an opening to ask you what sectors you like. If I have $1 million and come to you, where would you put it?
I think from our perspective, we still like the safety of large cap growth, so we still want some tech and comm services exposure. And the second to that, I think,
Mag 7.
Yeah, Mag 7-ish. Maybe you go down, cap structure a little bit, just given the size of the moves in that space recently. And then banks. I think banks is an area where people still want to be engaged. All the deals you're announcing is exactly what investors were hoping for at the beginning of the year. If they do roll back SLR and give banks a little bit of an opportunity to expand balance sheet, I think that should be incrementally positive as well. And that's been about 12 months. It was actually right around this time last year where that banks trade kind of kicked off, mostly from a deregulation angle. Now we're getting into the deal calendar, hopefully. So that's an area where we'd like to have exposure as well.
Okay, well, let's say I needed to fund those positions somehow, that $1 million that I wanted to put into large caps and into banks. Say I had to take it out of a certain sector. Where would you do that right now?
That's the tougher call. I think that's pretty nuanced trade at this point. I think you still want to be very careful with tariff risks. So things like consumer durables and apparels, I think, which have a lot of that tariff risk, I think you need to be careful with. Energy does seem to be continually a source of funds, particularly given, Trump's motivation to keep oil prices low. So those are probably two areas where we're a little more cautious. I would have told you healthcare, but once you get these deals kicking off, I think you want to be a little bit careful with the deal risk in healthcare. But that was obviously one of the worst performers last month as well, because it's been just a regulatory waterfall on that space. If you talk to PMs in the space, every time they think the stuff's fully priced in, you kind of get more news. But again, once you get deals being announced, I think you want to be very careful, especially in mid-cap biotech.
It's interesting to hear you say that on healthcare, because that was one of the bull cases coming into this year for the industry in 2020. 2025. And you saw a little bit of that in January pre-inauguration with Johnson & Johnson, for example.
Intracellular.
Exactly. Yeah. Then it was put on ice for a couple months now. Maybe it's coming back.
Yeah, we're starting, now we see another 20 billion in deals. That was, I think, 15 billion. I thought you were going to say you fund these things like the double line way, right? Shorting 30-year treasuries.
You could, I suppose.
And that raises, I think, a real concern. We're not there yet. Shanali's chomping at the bit for long yields to get out of control. But we're at 5% on the 30, right? 4.5% on the 10-year. Are you watching this closely? Are you worried that they may rise too much when everyone realizes we are spending way more money than we take in?
Definitely very, very, very concerned about it. I mean, we definitely saw real money kind of step in around 5 to 5.1% to kind of buy 30 years. But I think you have two risks here. One, you have just sort of a global spillover risk, which is if you get longer term yields to dislocate in Germany and in Japan, that can just force U.S. yields sort of mechanically higher. And the second is once we get this budget deal announced, it's not going to quote unquote score well from the CBO, and you could get pressure to the upside there. And I think incrementally what you worry about, clearly you have a supply-demand issue, but also you just have a lack of tools in the toolbox right now from both the Fed and the Treasury to really address this other than with languaging. So they're going to try to push back as much as they can verbally, but if they really need to step in, you're talking things like QE or pulling 20-year bond auctions, which we think are kind of last resort type situations. So you have a spillover issue, you have a budget issue, and I think you have a how do they deal with this if it actually happens issue.
You know, on this topic, there was an interesting note out from David Kostin at Goldman, I believe your former boss, who wrote that many investors point to 5% nominal yields as sort of a danger zone, a tipping point for stocks.
On the 10-year.
Yes, on the 10-year. He writes that we are less convinced, saying that it's more about the drivers and the rate of change rather than a specific level when it comes to yields. I'm wondering where you fall on that question. I mean, do you have a level in mind, or are you also focusing to the changes and the speed of them?
It's the speed of the change, and to David's point, it's what gets you there. You know, if you're at 5% because U.S. growth surprised us to the upside and it looks like we're getting a true soft landing, then yeah, clearly 5% is not going to matter too much to equity investors. If this is a supply-demand issue or an inflation issue, that's a completely different discussion. So yeah, I don't think obviously, it's interesting, and we do it too. Like whenever you come up with a key level, it always happens to be a big round number as well, right? It's always a 4.5 or a 5. I think David's spot on though. It's the rate of change, and I think most importantly, what is getting you to 5% is based on how equities are going to respond. You know, the fact is May was the best equity versus bond month in about 3.5 years since October 2022. Is that sustainable? You know, can equities continue to rally as bonds sell off? Our view would be yes, if it's growth driven. If it is inflation or sort of systematic risk driven, then no, then you're in a different story.
All right, Stuart, it's always great to see you. Great to kick off the second half of this year with you. That is Citi's Stuart Kaiser. And let's take a check on how this market is faring on the first trading day of the month of the second half. You can see the S&P 500 is down very slightly when it comes to the overall benchmark, but breadth is in the toilet right now. You only have 86, 87 names in the green right now. A lot of movement to the downside with more than 400 names in the red. You take a look at what's working right now. You do have NVIDIA higher. That's helping this benchmark. The same with Broadcom, Meta, Apple, United Health Group. But then you take a look at what's weighing on the benchmark. It's Alphabet, it's MasterCard, it's Johnson & Johnson, all some of your biggest decliners right now. So let's take a look at the sector level as well and break it down that way. You can see this poor breadth when you take a look at the bars as well. You have energy and tech gaining right now, but then you take a look at the bottom and it's a sea of red. You have real estate and financials at the bottom. You also have healthcare in the red, middle of the pack right here. And I think that's really interesting because if you click into that, you can see some of these deals news names that we've been talking about so far this morning. I go straight to Moderna, for example, getting FDA approval for a narrow group of patients for a new COVID drug. And then you have Bristol Myers Squibb, of course, up 0.7% right now. So let's zoom in a little bit more on that because they announced this morning a licensing deal with Biontech, and we're going to discuss that now with Sam Fazeli of Bloomberg Intelligence. And let's go there. This is a conversation, Sam, we were having at the start of the hour about how it seems like cancer is really the hot area when it comes to these health industry deals right now. Would you expect to see more of the same?
Yes, absolutely. I mean, look, I'm in Chicago for the largest cancer conference that comes around once a year. And frankly, you see some of the evidence and the data that's coming out. And I've been bullish about cancer in general, in terms of treatments that are coming along for quite a while now, because pretty much at every conference we get a big step change or practice changing data. And here, the deal that you've just seen Bristol Myers do with Biontech is on a new asset class. And interestingly, a whole bunch of those assets are just coming out of China. No one else has been developing them in Europe, US. And it's a new asset class that could, I want to emphasize could, revolutionize the treatment and immunotherapy again over the next 5 to 10 years. Could, not will.
So, by the way, do you think we're going to see more big deals? We were talking, Sam, about the fact that it looked pretty cold. I mean, we did see J&J Intracellular at the beginning of the year, but it looked pretty cold after that. And now we've seen $20 billion in one day, potentially more, potentially less, but around that. Is it going to start heating up, or is this just that, you know, Chinese treatment, BNT 327, that's kind of making waves?
Right. No, so it's partly that. The Sanofi deal that you've just been talking about also, that is not to do with oncology, that's immunology. That's what Sanofi believes is a key area that it wants to focus on, and I agree with them. Immunology, your immune system, touches pretty much every disease that there's out there. Now, the thing is, the sector started off excited, and then we had the administration come in with a whole bunch of issues that they brought up that are negative. I think your previous guest spoke about it. That just gave people pause. I've banker friends who say, look, we had a big book of M&A deals at the beginning of the year, and it all just kind of stalled because of this. Is this a restart of that? I'm a bit worried that in the next couple of weeks or 3 weeks, as my colleague Dwayne Wright in Washington says, we might hear about that most favored nation or the tariffs. And that's the thing that we're going to have to, or more about them at least, that we're going to have to worry about, that suddenly again putting a halt on people being enthusiastic about deals.
Yeah, absolutely. A lot of folks sort of holding their breath when it comes to more tariff details there. I do want to talk a little bit about Moderna, because shares are rising this morning, which it feels like is pretty rare to see. The reason why is because Moderna won narrower U.S. approval for a new COVID vaccine, sort of limiting the new approvals to folks who have some underlying risk factors, which is different than previous approval. And you can, again, see shares rising. But Sam, this is a real question, not flippant, but how many people are actually still getting vaccinated for COVID?
Yeah, so with all the questions that are being thrown at vaccines by some people in the administration, I think you have to worry that when it comes to actually people taking the shots in their arms, remember, vaccines are useless unless they're actually administered, right? People getting them shots in the arms, I'm a bit worried for going into that season. The narrower approval is as expected. I think the reason Moderna is up is because the approval came on the day that it was expected, or at least the last day that it could have come by. And so it shows that the administration and the FDA are still doing their job in terms of getting things approved. But what you need is the push to get people to go and get them. Not push necessarily, but the encouragement. I mean, it is a personal choice, but vaccines only really work and protect the population if a lot of people take them, not just a few.
Yeah, right. If I am the only one who takes it, and then everybody at Madison Square Garden for Fish doesn't, then I'm going to get COVID, basically.
There you go.
Yeah,
Sam.
It doesn't help our issue in that one of the things you want to do here is reduce hospitalizations. You need a lot of people to take them to really get that benefit.
All right. Appreciate the PSA. Sam Fazeli there at Bloomberg Intelligence, talking mostly about cancer drugs, and we're hopeful there, but some about COVID. Coming up, Starz setting out on its own and impressing in its first quarterly report. Jeffrey Hirsch, the CEO, joins us next. This is Bloomberg.
Starz shines in its first report since its separation from Lionsgate. The entertainment company added 530,000 streaming customers in the fourth quarter, and Starz says it's now focused on improving margins and streamlining its strategy for original content. Joining us now, I'm pleased to say we have Jeffrey Hirsch. He is the CEO of Starz. Jeffrey, great to see you in person.
Hey, thanks for having me. Excited to be here this morning.
And I have to imagine this is some validation, a real proof of concept that Starz should be a standalone business.
Yeah, look, I think the corporation made the right decision to separate the companies and put the value in both the sides of the Lionsgate side and the Starz side. I think you're seeing the great decision by the board coming to fruition with the stock price on both sides moving and putting the value in the right place on both companies.
So what is your target audience? I mean, we were just talking a little bit during the break about HBO Max has made a number of changes. You've worked there too. So what are you doing at Starz? What's your focus?
Yeah, we're really focused on really two core demos, women and underrepresented audiences. When we launched our OTT product in April of 2016, what we saw was driving our business was women. And so we leaned into that very significantly, and our programming mandate now is narratives for, by, and about women and underrepresented audiences. So shows like Outlander, shows like P-Valley, the Power franchise really leans into that. It's very adult, very R-rated. We don't have any advertising, and so we'll continue to really focus on that. And that makes us a very complementary bundling partner to most of the broad-based streamers out there that you see today. So we think we're really uniquely positioned in a very competitive space today.
So R-rated content, not something that you would pop on at home.
We used to call it Skinamax, but that's what you are now, right?
No, I think we're a little more elevated in terms of scripted dramas, but I appreciate the reference.
Yeah.
No, look, I think there was a time and the place that Cinemax had its run back in the day, but you know, we've got some of the biggest shows on television with Outlander. We have the prequel coming this summer on August 8th. We premiere BMF this weekend, and these, you know, it's really more of where the story goes naturally, we go there, right? And
BMF
so we don't,
is Black Mafia
family. Yes, it's 50-cent show, really big show for us. We're excited to have it come back on the service. But for us, you know, when the natural story goes to certain places, we allow our creators to go there, whereas other services kind of pull them back because they want to put ads against it.
So there's plot, of course. And I mean, you think about Game of Thrones, the best television show of all time, in my opinion, obviously was R-rated.
I hear people in this office saying that about Outlander. I mean, they
really?
love it.
True,
yeah.
true.
I mean, Outlander is one of the biggest shows on TV, and you know, we have a prequel coming which takes us back to 1700 Scotland, and it's the love story about how each of the leads from Outlander's parents met and fell in love. So there's a little bit of a Romeo and Juliet story on one side where it's forbidden clans and they fall in love, and the other side is a World War I story. And so we're really excited about it. But I think all of our shows are, you know, we have 5 shows that do between 9 and 12 million eyeballs a week. Those are some of the biggest shows on TV, and so we're really excited about our content strategy and the place that we play in the whole ecosystem.
This leads nicely to my next question. We heard from your chief financial officer recently on your conference call with analysts saying that you see roughly $700 million of content spending in 2026. Can you give us more detail on that? Is that for some of your existing franchises, your existing shows, or you also are you putting that towards developing new content?
So what's in that number is a combination of our big originals. There's a Lionsgate Pay 1, which is the first movie windows that come to that, and a Universal Pay 2. And we think that the portfolio of content really makes us a very compelling service at our $11 price point. And you saw that in the first quarter numbers. We actually grew the U.S. subscriber base total by almost 2% in the first quarter, which is a really, really good accomplishment in a very competitive space. But we have a programming group. We've got 40 to 50 shows in development at any given time. And as we talked about on the call, we want to go from a 15% profit margin to a 20% profit margin by end of 2028. One of the ways that we get there is actually by turning the slate over and putting new shows on the air that we can own as we separated from Lionsgate. And so ownership economics is really important because season 1s are much cheaper than seasons 5, 6, and 7.
Right.
And we can also put international sales back into the business, which is another way to net down the cost of a show. And so as we separate, we just announced that we opened 4 writers' rooms in the last couple of weeks on some really compelling shows that I'm excited about. As we start to move into 27, you'll start to see more of our own shows come on the slate.
I imagine, you know, with something like Outlander, you can get people to come and pay $4 a month, which is what your special offer is right now. Can you grow that over time as you have these massive competitors like Netflix, like HBO, or do you have to hold it at a lower level?
So, one, we don't see them as competitors. We see them as complementary services. If you think about the old traditional world, Starz was always set up as a cherry on top or an additive to broad-based services. So Comcast for a long time sold Starz on top of expanded basic television. We think that world gets replicated in the digital world, and so we've always positioned ourselves as being a complementary add-on to the broad services like Netflix, like Amazon, like Hulu. And so we will always be priced well below the broad-based services so that we are viewed in the consumer's mind as complementary and not competitive.
Before we let you go, I do want to talk a little bit about your business, because I believe you derive about 70% of your revenue from streaming. That leaves about 30% of your company exposed to, cord cutting. So how do you plan to deal with that over time? Is that something that you're trying to whittle down, that 30%?
Look, we really follow the consumer, right? And so as the consumer has shifted from linear to digital, we kind of followed the consumer there. But I think there's a real value in still the linear business today. What's interesting about all of our customers, 80% of all of our customers are either added on or a la carte, which means customers chose Starz. It wasn't we're in a bundle, and so that we see the cord cutting and we're just the natural evolution of cord cutting. People have actually picked Starz because the content is working. And what it also means is that we actually are a revenue generator for our partners. And so I actually think that there's a lot of opportunity still in the old traditional world for us as the content continues to roll out, that there's opportunities to grow that business. And actually what we saw at the end of the first quarter was a lessening of the cord cutting loss. Now, it's a little bit of time. I wouldn't claim victory on that yet, but our hope is that loss starts to slow, and that's additive to the long-term health of the business.
All right, Jeff, great having you on the show. Thanks so much for joining us.
Thanks for having us.
Jeffrey Hirsch there, the CEO of Starz. Got to get a quick check of what's going on in markets right now. We did see a turnaround for a bit on the NASDAQ. It's back down. I think NVIDIA and some of the other Mag 7 stocks are really holding it up there. We saw most of them gaining, right?
Yeah.
Alphabet, Google was down, but you had NVIDIA up, as well as Apple and...
Yeah, when you have more than 400 stocks lower, even the might of NVIDIA and some of those Magnificent Seven, you can see sort of it comes out in the wash. We're going to get into it next. Don't go anywhere. This is Open Interest.
We are 30 minutes into the trading day, looking at red arrows across the board to kick off the month of June.
We are, but of course, as you've been talking about, we saw the best May in 35 years. We had a stellar performance, but a lot of the things that made May great, let's see if it lasts through June.
All right, welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak. And Matt, we're looking at a market here that is trying to absorb these trade tensions, also economic data. We are looking at the lowest ISM manufacturing imports since 2009. We're now going to talk a little more to Michael McKee about that because, of course, contraction territory is what investors are looking for here. How much does this economic data show the softening that's under the surface?
Oh, it's starting to show the softening pretty strongly. We see not only the decline in the headline number to 48.5 from 48.7, which is lower than anticipated. New orders are still negative, 47.6 from 47.2. And production still negative, 45.4 from 44.0. Even employment, 46.8 from 46.5. So a bad report all around here. New export orders fall to 40.1 from 43.1. And imports, this is tariff related certainly, 39.9 from 47.1. So all throughout this number
so confusing. I thought we were pulling demand forward. Are we not pulling demand forward?
We pulled demand forward. This is the first numbers that we are getting for May. And the May numbers, people have been starting to expect that we would see this sort of thing happen, that it would start to show up. And obviously with manufacturing, imports and exports being such an important part of it, that we're really seeing it start to show up here.
And really quickly, Matt, I just want to point out that the S&P 500 now is down 0.8%. The reason I think that's interesting is yield also lower. The 2-year dropping, quite a significant drop after the data, but the lower yield's not helping the market.
Yeah, I was looking at the 2-year as well. We did see the yield drop there. The 10-year also falling now to 4.41. So a pretty significant drop in yields. Mike, what do these numbers say to you about the economy?
says the economy is performing about as you would expect, which is not good news because we've been expecting to see the economy slow down on the back of the tariff threats, and we'll see what happens with the budget numbers when they come out. I'll point to one comment from this here. It says from a computer and electronic products company, government spending cuts or delays as well as tariffs are raising hell with businesses. No one is willing to take on inventory risk.
All right.
Brutal.
People are cutting back.
Yeah, very interesting. All right, so no more polling demand forward, at least in this ISM report. Mike McKee, thanks very much for that. Let's get to Raquel Oden. She is HSBC Head of Wealth and Personal Banking. And Raquel, I wanted to kick it off with you on earnings expectations, but why don't we talk a little bit first about the U.S. economy and these tariff concerns, because I think it's safe to say the U.S.-China trade war has been brought back to the top, to the fore, so to speak, as both sides accuse the other of breaking the agreement. How do you feel about this reignition of tariff concerns?
I don't know that it went away. So I would say both tariffs and the trade policy of this administration continues to drive uncertainty in the markets, right? So the volatility we continue to experience truly is based on the continual directional change of tariffs. I think what's key about that, as you've mentioned, why this is so key, is when we think about what's going to actually ultimately happen is we've taken this 90-day pause, which has allowed the markets to take some level of recovery. But you will need some resolution in July. So that early July timeframe is going to be very important to see what the administration finally does. And the reason why we know this is, thankfully, equity markets are resilient. They've done extremely well. Take a look at Q1 earnings for corporates. We predicted that to be around 7.1%. They came in at 12.9%. We just talked about the NASDAQ. We talked about, very importantly, what we saw with the S&P record since November of 2023. So we know equity markets are resilient, but at the same time, we really have to be concerned about when are we going to get these rate cuts.
How would you describe the risk appetite among your clients right now? Is it kind of a pent-up energy to start investing again? And what does that entry point really look like at which they're willing to get in?
So what we've seen from individual investors, which is really important, it has been stay the course, right? So it really isn't about should I enter or exit. It was to stay the course. And as we just saw, equity markets did recover, right? So that's the positive. What we are starting to see, though, is the opportunity of, is this a buying opportunity due to the volatility that we continue to see within the equity markets? But it also points to the bond market, right? And I think we're all seeing some complexity there as it relates to, again, the indecision on tariffs. When you think about, for our individual investors, we've really talked about locking in some of the long-term bonds right now, not for corporates. That makes sense for individuals because they can actually lock in some yield.
If we do get trade deals, right? I mean, I know it doesn't seem like President Trump and President Xi are likely to play golf this week, but if we did, you say that's when we expect earnings revisions to the upside. So how do you position yourself for that ahead of such an uncertain event?
Agreed. So diversification, very important, very key, but I absolutely agree with you. The one resolve we're all waiting for is really the decisioning on the tariffs. So that allows two things to happen. You have a rate cut potential. We're still saying 3 as of now, probably more in the July, September, November timeframe. But at the same time, we expect earnings next year to now actually be recasted closer to 13.9% to 14%. The markets are healthy, right? The fundamentals are healthy. What's really holding us back is the indecision around tariffs. And what we're currently using as our international policy is causing quite havoc on the markets. But ultimately, if we resolve that, we finally get to the point of us focusing on what the administration originally promised us, the three-legged stool, which was really tariff, tax cuts, and very important deregulation. We need to get back to that and get out of the tariff debates.
The awkwardness about the tax discussion, though, is what you're seeing in not the havoc in the stock market, but the bond market. This morning, Bob Michel had told, or said last week, rather, Bob Michael said that he doesn't want to be the one to stand in front of a steamroller right now, right? So if you're looking at that long bond, then why do
By the way, the story, fantastic story, right, by Michael McKenzie and Yishi about how BlackRock and PIMCO and TCW, not BlackRock, I meant DoubleLine. They're actually shorting this debt.
So why get in?
Yeah, so I think from the standpoint for individual investors, I'll go back to individuals. This is a time to lock in long-term yields. If you are corporates or private equity, no, right? Because the volatility is really there and you're not going to see the short-term return. So for individuals, it's actually an opportunity. I'd say for corporates, no.
I actually highlighted that Bob Michael quote as well.
It's
So I love
fascinating.
that.
It's excellent.
Raquel, I want to ask you about AI because you have some interesting points about how AI will change not just the world, but also the way we do business, the way you do business on Wall Street.
So I just take a look at, you heard from NVIDIA, the real importance of what you're seeing from an AI standpoint around productivity, and that is going to change the paradigm. I think what's important about that is when you take a look at the last, what I call job cycle, about 300,000 jobs went away, but 1.3 million were actually created specifically around manufacturing and then very importantly around data centers, because AI is shifting where we're going to need people. So to me, AI is the opportunity of a workforce that may look different in sectors that will be different, but you need that complement to really drive that productivity. So we're excited about what AI can do. Again, the winner will be the horses that actually win, which will be interesting to see which companies get that right. But ultimately, every corporate, every industry has to be figuring out how they're driving this for productivity.
Raquel, we thank you so much for joining us here on set this morning. Of course, complicated morning. Of course, also seeing a reversal of the trade that we saw in May just a little bit today. But let's get a look at some of those single stocks moving under the hood this hour. Tesla is the laggard among the Mag 7 stocks. Sales plunged to an almost 3-year low in France. Of course,
In France?
Yeah.
That's a relatively small market for Tesla.
That's also different politics there.
No, for sure. Exactly. No, that is a very good point. I mean, they're very different politics than, say, Florida.
Right, but everyone is picking apart the Tesla story right now, watching Elon Musk very closely. Broader tech, though, is still kind of wavering in the trade. We are watching NVIDIA kind of trying to push that NASDAQ higher, but not so much after that ISM data. We're still seeing it lower. We're also seeing DraftKings lower by the tune of almost 8%. Here, Illinois lawmakers proposed a sports betting tax increase in the fiscal 2026 budget. Illinois probably matters more for DraftKings than France does for Tesla.
Yes, for sure.
Absolutely.
By the way, Shonali, if there's an extra tax on sports betting, you'll pay it, right?
I'd pay it, but I'm also doing it as a thought experiment here. I got to place that bet, but of course, there was some heartbreak for me in the basketball landscape this weekend, so watching a little less sports these days. And lastly, we are watching Blueprint Medicine soaring because Sanofi agreed to buy the biotech company for over $9 billion. And we're going to talk more about that deal right now. We are joined by Bloomberg M&A reporter Michelle Davis. A soaring Blueprint right now. Interesting merger Monday in the healthcare sector. This is really where you cut your teeth in a lot of ways on the deals team. What's going on?
So we're finally seeing some biotech deals. It had been the year that everyone predicted, as you know, was going to be a bonanza for deal making. And after seeing J&J in January announce a $15 billion deal for Intracellular, there was nothing in biotech. We saw a smattering of private deals. Today, as you mentioned, Sanofi's buying Blueprint, $9 billion. What's really interesting about this is if you look at where the stock was trading in January, it's actually, they're not buying it at a huge premium to that. It's about a 13% premium to the high in January. And what that shows is buyers and sellers are finally meeting in the middle. It is a buyer's market, and we're seeing sellers having to give up some value in order to get these deals done.
So Sanofi buys Blueprint, which has a bunch of medicines, immunology medicines in the pipeline, right? Not a lot that's already on the market. If we talk about Bristol Myers Squibb, they're buying a Chinese treatment that is really promising for cancer treatment. What are they looking at?
So this Bristol Myers Squibb deal is more of a collaboration partnership deal with Biontech, and it follows a big trend that we've seen over the past year where U.S. pharma companies, European pharma companies are really looking towards China for a lot of their innovation because
Kaiser
there's a lot
as well.
of innovation happening there. What I think is really interesting about both of these deals, the Sanofi deal and the Bristol Myers deal, is that they're cross-border deals, which we hadn't seen a lot of this year because, trade, geopolitics. And I think what it shows is companies that had put a pause on some of their big decision making, they're finally looking through some of the noise and deciding, we have these pipelines that we have to replenish. They have drugs that are going off patent. And so they just have to kind of ignore the noise and announce deals.
Super interesting in light of all of that U.S.-China rhetoric, the tit for tat we're seeing. I'm actually headed to Hong Kong next week for Bloomberg Invest, so we'll bring back some of that color there as well.
Stay safe.
Yeah, I will.
Watch what you say when you're there.
And watch the general environment. I guess COVID is back on that side of the world, too. Michelle Davis, of course, Bloomberg's M&A reporter. And coming up, a tiny ratings firm has become a significant player in the private credit market. More on why that's raising concerns among industry insiders next in the Wall Street Beat. This is Bloomberg Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. Rivian is planning on selling nearly $1.3 billion of green bonds to refinance upcoming debt as EV demand slows. It's rare for an offering to be tagged with an ESG label these days for obvious reasons. U.S. companies have retreated from the green bond market because of the Republican-fueled backlash against the investing strategy. Sales of green debt are at the lowest levels in years, according to Bloomberg data. Campbell's Soup sales returned to growth last quarter as penny-pinching consumers opted to eat in more often. The CEO says consumers are cooking at home at the highest levels since early 2020. Guidance at the soup company was largely reaffirmed, and its outlook excluded a tariff impact that could be up to 5 cents a share. And in an interview on Fox Business, Jamie Dimon said his retirement from the top post at JP Morgan is several years away, but the decision is up to the bank's directors. The question of when Dimon will retire and who might succeed him has hung over JP Morgan for years. Dimon used to joke that retirement was 5 years away, no matter when he was asked, but he's recently stopped giving that answer. And I think I would be sick of asking the question. Shonali, would that be one of your questions if you interviewed Jamie?
I think here's the problem. He's almost 70 years old, and 65 used to be the retirement year. Matt, it's really interesting. You take a look at JP Morgan, and not only have they been flying high, JP Morgan has been in the news a lot, not only because of Jamie Dimon and his warnings about the economy, but because they are almost, and this was a big economist profile just a week and a half ago, they're about to be really the first $1 trillion bank. They're a little ways off from that still, to be honest, but they have the shot at getting there. But can his successor take the bank there? That is the massive question. Remember, Jamie Dimon is also the chairman of the board of JP Morgan, so he is part of that larger discussion.
I mean, he's done incredibly well for shareholders, right? JP Morgan shares have tripled in the past 5 years, and he's only 70. People live a lot longer these days. The president of the United States of America is 78.
Right, he would be kind of the perfect person to push for that expansion of the retirement age.
Yeah.
Anyways, we're going to talk now about the Wall Street Beat, an area that Jamie Dimon has actually been very critical of, private credit. Now, Egan-Jones, a small ratings firm, has become a significant player in the private credit market, grading over 3,000 investments last year with a team of just 20 analysts. However, the firm's fast growth and optimistic ratings have raised concerns. Joining us now, private credit reporter Silas Brown. You know, people talk all the time about marks in the private markets. But when it comes to credit ratings, here's the problem. Ultimately, you're seeing these loans packaged, sold off, exposed to a wide range of investors. People really worried about kind of another version of CDO squareds being created when it comes to private credit. Ultimately, what does this story say about how this market is assessed?
Yeah, so I think a very good way of contextualizing the importance of ratings firms is to do with the rise in insurance capital within the industry. I think you probably know more than I do, insurance money is a kind of key source of scale for the industry. The thing with insurance money is that it needs ratings. And so when US life insurers go to seek ratings on all of their investments, they have a variety of options. They can go to the big three, they can go to specialist upstarts like KBRA or DBRS Morningstar, or they can go to even smaller firms like Egan-Jones. And Egan-Jones has developed this niche, somewhat of an outsized influence given the scale of it. It has 20 analysts. Up until recently, it operated from a 4-bedroom home on the outskirts of Philadelphia. But they have managed to carve this niche and become pretty popular as a choice for fund managers and investors.
The outskirts of Philadelphia are super nice, Silas. And when you tell me that a firm of 20 people is doing so much work for Wall Street, I'm thinking they must be cashing in. So who's behind this growth story, and how are they doing it?
Well, so you're right, and also it's based in Haverford, which is due to my Google image searches. Very, very beautiful, very beautiful place. It is founded by a man called Sean Egan, who has been, a fixture on the ratings scene for about 30 years. He first grew to prominence with early, kind of timely, accurate calls on Enron, and has since managed to convince the regulators to validate his ratings firm alongside others, all kind of alongside the performance of the big three when it comes to subprime. The sort of subprime fiasco in the great financial crisis.
Silas, I think there's an important line in your story that. Go ahead, please continue. What were you saying?
No, you go ahead.
Oh, well, so there's an important line in your story that I want to cut to, because you mention in the story that this is not necessarily a repeat of 2008. But at the end of the day, life insurance capital, if one life insurer were to hit significant pain, then the way it works in the U.S. is that the entire system is really on the hook for a bailout. Why is this potentially a larger issue for the investment community? Because there are ripple effects that could be seen if something were to go really wrong.
Well, I do think, I'm not in the business of being alarmist, but what I would say is there are quite reasonable examples of deals that are rated investment grade that have characteristics of, mainstream leveraged finance loans. Their margins are very high, for example. I mean, we've seen BBB rated assets with margins of 10 to 14%, which, I mean, at the time of signing those kind of deals would put them actually below the mainstream of leveraged loans and put them more into the CCC category. And so there's clearly this kind of, admittedly on the fringes, there's this kind of mismatch going on in terms of the mainstream conventional bond markets and what they see as acceptable methodology for ratings, and this kind of new, very exciting, booming, somewhat untested market in private credit. And I think this is becoming more significant given the scale of interest from US life insurers. JP Morgan estimates US life insurers have almost $1 trillion worth of exposure to various forms of private credit. And so I think the situation is becoming more pronounced and will be for the years ahead.
Silas, great having you on the program. Highly recommend everybody check out your story. Silas Brown there in London writing our big take today. I want to get a check on what's going on in the markets. We have losses across the board. The S&P 500 right now down 0.4%. But we did have a pretty good May, right? The best May since 1990.
It was incredible, and it brought you back most of the losses that you had the prior 3 months. But as we've been talking about, that was based on an easing of the tit-for-tat between the U.S., China, and other trading partners. We're starting June with some of that coming back.
All right, that is how we're starting June. This is Bloomberg. We are still looking at more than 400 stocks down on the S&P 500. This is the move screen, MOV Go on your terminal. Very dynamic way to look at the index. You can see NVIDIA is up more than 1%, so it adds 4 points to the S&P. That's not enough to offset all of the losses that we're seeing in terms of points being led by Tesla. Then you've got Google, Amazon, Apple, Visa, MasterCard, so a lot of big stocks on the way down. When we come back, more women are saying yes to lab-made diamonds than ever before. We'll get a read on the market with Ankur Daga, the CEO of the online jeweler Angara, next. Would you buy a lab-grown diamond for $1,000 instead of paying $10 for one that was mined with blood? That's the question on Open Interest. Lab-grown diamonds continue to put pressure on the $370 billion global jewelry market. For the first time ever, more than half of all engagement rings were made in a lab rather than being mined by people who would probably rather be doing anything else. Despite the boom, De Beers says it will be closing its lab-grown diamond jewelry brand, Lightbox. Why? For more on this, we're joined by Ankur Daga, Angara co-founder and CEO. Angara.com has been named Newsweek's top online jeweler for 5 years in a row, so congratulations on that. Dude,
Great to be here.
Why? This was shocking to me. Why would De Beers bail on this business when lab-grown diamonds are already almost impossible to discern from the real thing?
Yeah, just to back up. So 2018, the FTC said a lab-grown diamond is a real diamond. They're chemically, physically, optically identical. That's also the same year Lightbox started with De Beers. The idea for De Beers was to position Lightbox as a lower-end product, fashion jewelry, and natural diamonds as fine jewelry. That didn't end up panning out. So now lab-grown diamonds are 90% cheaper than the natural equivalent for something that's chemically, physically, optically identical. So lab has really taken off and really is replacing natural diamonds. And De Beers' primary business is natural diamonds. So they want to push much more on the natural diamond side and reduce their focus on the lab-grown side.
Who are the biggest buyers of the lab-grown diamonds and why?
So this year, 55% of engagement rings in the US have lab-grown diamond centers. Just to back up, in 2018, that was 2%. So in 2018, less than, I would say 95% of all engagement rings sold were natural diamonds. Now it's 40% in just a decade. So 15% of engagement rings sold now are colored gemstones, and 55% are lab-grown diamonds.
So what kind of gear do you need to be able to discern a lab-grown diamond from, one that's pulled out of the ground in Botswana?
Yeah, so the fascinating thing is any jeweler anywhere in the world with a 30x loop or a 10x loop cannot tell the difference. Only specialized labs like the GIA or IGI can. There's very small nuances that are different. So for example, lab-grown diamonds are nitrogen-free, and natural diamonds have small traces of nitrogen. Ironically, the most sought-after natural diamonds are also nitrogen-free, the Golconda Type 2A diamonds.
So ultimately, is this about the pricing? Do people buy this because of the social aspect of it, because it's a better thing to do for society, or are people buying it because it's more affordable?
So Gen Z is doing it for both reasons. If you're buying a 2-carat diamond engagement ring, you're spending $25,000 on the natural product, $2,500 on the lab-grown product. So clearly that's super compelling. But there's also much more sustainable. It's grown in a lab. So for each diamond that comes out of the earth, there's 1 ton of dirt displaced. That's not the case with lab-grown diamonds.
So, someone like me who knows nothing about the industry, but has seen a Leonardo DiCaprio movie,
sure,
assumes that all real diamonds are kind of like blood diamonds. Is that an unfair assumption?
That is an unfair assumption. Yeah, so there's Kimberley processes there, and all jewelers are Kimberley process compliant, which is diamonds have to be ethically sourced and produced and mined. So they are perfectly ethically made for 99.9% of diamonds, and especially everything sold in the US. So that is not a worry. That being said, you are displacing 1 ton of earth for every carat of diamonds.
Here's the thing, an engagement ring is a massive investment. And if you're making that investment, what I'm wondering is, when it comes to lab grown, and I thought this way.
I see it as a token of love, but you see it as a financial investment.
I see everything as a financial investment, time, money, everything. So when you think about the investment, what is a lab grown diamond worth in 10 years, 20 years, 50 years, 100 years? Is it a depreciating asset, or do you think that it actually has a chance to go up in value?
So lab-grown diamonds will not hold value. So to resell, it's very difficult. That being said, natural diamonds have gone down in price by 40 to 45% over the last 3 years. So the typical reason somebody bought a diamond is for 2 reasons. One is financial flex. So if you're wearing a 2-carat to 3-carat ring, it says something about you. The other is it's an inflation hedge. It used to appreciate 2 to 3% faster than inflation. Both of those things are no longer relevant because you could buy the lab-grown equivalent for 90% less. And they've depreciated 40 to 45% over the last 3 years.
Right, I'll be honest. My jeweler said that the only disadvantage to buying a lab-grown diamond was the ability to resell it at the diamond district.
And it looks like you're losing that ability with the real one as well.
Yeah, apparently.
It's dropped that much in value. Tell us about your business. How is Angara doing right now? What kind of growth are you looking at?
Our growth is in the high 20s. and we're growing very quickly. We've been growing at 30% per year for the last 10 years. We crossed 100 million in 2022. We expect to reach $1 billion in revenue in 2030. We're pretty unique compared to most other jewelers in the sense we're completely vertically integrated. So we'll buy gemstones and diamonds from mines. We'll cut and polish those gemstones. We will design our own jewelry, manufacture our own jewelry, and then retail over the web. UK, Australia, Canada, as well as the US. We just launched in India. We were just launching in the GCC countries end of this year. So growing very quickly.
Do you want to stay independent, or do you see yourself selling to a larger jeweler?
For us, this is a 50-year game plan, and we're year 20 into it. We would like to stay independent. It gives us a lot of flexibility. We like to be able to sell natural and lab diamonds in color and really promote color, and that's what we're all about.
India, by the way, is the world's fastest growing diamond market, according to the CEO of De Beers. And I'm talking about natural diamonds. It's grown 12% annually. Ankur, thanks so much for joining us. Always fascinating when you come on. Ankur Daga there of Angara talking to us about lab-grown and real diamonds that you can get on his site. Let's get a quick check of what's going on in the markets. We're seeing the NASDAQ buoyed by NVIDIA's gains. The S&P 500 still down as 400 stocks lose. And the 10-year yield, it's coming up pretty low at 442, right? Doesn't that feel good? Don't you feel like a little bit loose and free with the 10-year yield at 442?
I do feel loose and free. That's hilarious. I was looking this morning just for you. It was at 4.8% in January. That was the new danger zone before that 5%. We're not getting there. And in fact, we're pairing some of that yield drop, but not that much.
Scott Bessent said he would bring down the 10-year yield by reducing the government deficit to 3% from 6%. So maybe he's on his way.
We're going to keep an eye on that this week. We're going to talk more about that in the next block, too, with Henrietta Treyz. But for now, we're going to take a look at some single stocks moving at this hour. We're going to bring in Bloomberg cross-asset reporter Isabel Lee. You're looking at some M&A, I believe.
Definitely M&A. So it's Bristol Myers will pay Biontech, $11 billion to license a next-generation drug. So this is a big deal because this area of the market, the immuno-oncology department, is really growing fast. We have Bloomberg Intelligence estimating that it will grow as much as $60 billion in terms of target sales by 2027 per year. So we have Biontech saying they will receive a $1.5 billion payout upfront and $2 billion in installments. So you see shares there edging higher by 3%, at least for Biontech, but Bristol Myers is kind of flat by just 1%.
I think it's one of the most interesting stories of the day. The idea is to use your own immune system to fight tumors, and apparently some Chinese biotech figured this out. Now Pfizer has paid $6 billion. Yes. Now Bristol Myers Squibb is paying maybe $11 billion, depending on some milestone. So
yeah,
I think really cool. Boeing, I find it to be less interesting story just because I just find Boeing less interesting.
No, now you do.
No.
He was super interested about it 2 months ago.
Boeing shares are flat. We have the company, Bank of America, upgrading the stock to buy from neutral. The analyst there, Ronald Epstein, says that the company's aircraft emerged as the favored trade of tool for the Trump administration. So he raised the price target to a street high of $260, up from $185.
He wants to get them more deals, but he was so angry at Boeing on Friday. He said they got to get their act together. So they still are messed up in Trump's opinion. And I guess there's a lot of room to run, right? Because in the last 5 years, Boeing's up 35%, Airbus is up 175%.
Yeah, it is lagging materially, and it is one of those national treasure type companies. Up 18% on the year, though, so not bad given what you're seeing in the market. The real big story of the day, steel stocks. Interesting to see this move. My question about this is, yes, you see Cleveland-Cliffs soaring, but if steel prices go up because of tariffs ultimately, what's the net effect on demand?
There is a lot of moving parts, and you see shares of U.S. steel stocks in the U.S. rising, but in Asia, Australia, and even Canada, they were sliding, obviously because we have Trump saying that tariffs on steel and aluminum will rise to 50% from 25%. So that's really double rate. That Nucor is also surging as much as 11%. We see, now it's 12%. And then among other movers are Cleveland-Cliffs, Steel Dynamics. So BMO Capital upgraded Nucor to market perform and downgraded Canada's Algoma Steel. So you really see a lot of moving elements in this story. But yes, it will really, we'll wait to see how the demand will affect.
My question is, are we selling U.S. steel to a Japanese company? Are we, when you're on the cross-asset desk off of camera, do you guys say, Nippon Steel is buying U.S. steel now?
Yes, we do, and we say so many more other smart stuff.
My question is, can the domestic steel producers keep prices low enough to offset any price rises from international steel companies?
They're going to raise prices to just under the tariff level. That's what happens. That's why these shares are. So when you raise tariffs to 50%, that means U.S. Steel, Nucor, Cleveland-Cliffs, they can raise prices almost 50%.
But will it suppress demand? And how much will it suppress demand? So
we need to ask Joe Doe about this stuff, right?
Yes, we will bring that back.
Joe Doe on camera.
Yeah.
A couple days away.
Couple days away. But this is interesting because Trump made this announcement while visiting U.S. Steel Corp plant in Pittsburgh. So, I mean, is there a certain element of emotion there after seeing them? And he's saying, protect America. So we'll see.
Isabel, great having you on the program. Isabel Lee there from the Cross Asset Desk. Coming up, we're going to discuss the latest on Trump's, well, we'll talk about this, tariff agenda, as well as the tax bill to come. I mean, it's so far off. I don't know what we're going to say about the tax bill, but we'll talk about all that with Henrietta Treyz. We'll ask her how far off it is. Veda Partners Economic Policy Research Director joins us next. This is Open Interest.
People are not, well, we all are going to die. For heaven's sakes, folks. Okay, no, but what you don't want to do is listen to me when I say that we are going to focus on those that are most vulnerable. Those that meet the eligibility requirements for Medicaid, we will protect.
That was Senator Joni Ernst speaking at a town hall over the weekend about the substantial reforms to Medicaid included in President Trump's tax bill. The Senate begins closed-door talks on the legislation this week. Joining us now is on the latest is Balance of Power co-host Kayleigh Lines. So kind of stepping in it there, Joni Ernst pointing out that we're all going to die, and we're still going to serve, she says, the most vulnerable with Medicare, right?
Well, that's the argument that Republicans are making, that those who need Medicare and SNAP benefits the most will still be eligible. It's about tightening up restrictions on able-bodied people in regard to work requirements and the like. But there are still some senators who don't have this good feeling about the cuts that were in the bill that the House passed. That includes the Republican senators Josh Hawley, as well as the likes of Susan Collins, who is vulnerable in 2026 as she seeks re-election in Maine potentially. So that is going to be one big sticking point, knowing that that is where a lot of the spending cuts actually are. And there are still even more senators who are calling for further spending cuts in order to get their support for this legislation, like Senator Rand Paul, for example, who is upset that this raises the debt ceiling. Senator Ron Johnson making a lot of noise about the fiscal impact here as well, knowing that the Senate bill price tag ultimately could end up being even trillions of dollars higher in terms of the deficit impact than the House bill was, because they would like to make a number of measures that were not permanent in the House legislation permanent in the version that passes the Senate. So that's just a few areas of difficulty. There's others as well, including the rollback of clean energy credits, more than $500 billion of them from the Inflation Reduction Act, that is causing some strife among the likes of Senator Lisa Murkowski of Alaska or Shelley Moore Capito of West Virginia. So there is a lot of different moving parts here that the Senate Majority Leader John Thune is going to have to navigate if he wants it to pass his chamber ultimately, which of course they want to do by the 4th of July. But the other difficulty here is whatever the changes the Senate can agree to and make have to get back through the House. And it was very narrow passing the House the first time. 215 to 214 was the final vote. The Speaker was walking, he described as a piece of floss over the Grand Canyon. And if there's too many changes in the Senate passed legislation, it could be difficult for the House to swallow it when it returns back to the lower chamber.
Balance of Power co-host Kayleigh Lines, we thank you so very much. We're looking forward to your coverage, of course, as we watch the Senate parse through this bill. Joining us now, Henrietta Treyz, Director of Economic Policy Research at Veda Partners. How do you expect this to play out? You have been watching the bond market kind of hiccup at the thought of what the fiscal situation looks like in the United States. Investor after investor who speaks to us say it maybe doesn't matter until that 10-year hits closer to 5%, or at least the January highs. Does it matter ultimately? How do you expect this bill to get through Senate?
I do think it's going to matter. And one of the areas that I talk a lot about with our clients, and especially the bond focused folks, is that the Senate, unlike the House bill, uses a current policy baseline, which is kind of like the ultimate budget gimmick. It covers $3.8 trillion worth of deficit increases and says the cost is zero. So for bond market participants, there's a big difference between the House and the Senate bill, and that's really the core feature. And then in terms of, as y'all were talking about in the last segment, the overall deficit increases, the number is going to be somewhere between 3 and 4 trillion. And that's what the markets are going to have to digest as the Senate spends the next 4 weeks writing this package on their side.
So what do you expect them to do, especially in terms of tax legislation, Henrietta? I think a lot of people are watching what they're going to have to pay.
Yeah, the tax side is going to be $4.5 trillion worth of stuff. And that's going to depend on how many of those cuts you were just mentioning they'll be able to get out of Medicaid. There's 10.3 million people that will see their Medicaid cuts lost, and most of those are coming from red states. So Jim Justice in West Virginia, as you mentioned, and also the Alaska senators are really fascinating because they're going to get hit twice by the IRA repeal, which is $550 billion in the House package. And that has to come down to like $250 billion worth of cuts that they're willing to adjust. 70% of that bill goes to red states, and Alaska gets hit really hard. They also get the double whammy. I think it's something like a third of Medicaid recipients in Alaska would get off the books. And Dan Sullivan is another member who's up for re-election next cycle. So those are the big questions that they're going to have to address. And the path of least resistance as a seasoned Senate hand is you just spend more money. So this bill will get a lot more expensive on the Senate side as they try to thread the needle with only 2 votes to spare on the Senate side.
I want to shift now from taxes back to tariffs, that first leg of that stool. A lot of news over the weekend and a lot of concern that the tit for tat between the U.S. and China is picking back up again. How do you talk to investors about how that might play out?
Yeah, IEEPA, in retrospect, might look like a cakewalk. I think we are walking into pretty extreme uncertainty here. I've learned at this point not to say peak uncertainty because it can always get more wild, but we are really going to be on Section 232 and Section 301 watch from here on out. If the president even wants to avoid the issue of running into a problem with the courts later on, he knows he has the authority to escalate $550 billion worth of goods in their tariff rate under Section 301. So our clients are very focused on that, as are we, and especially the potential for the announcement of new Section 301 investigations, and that paving the way for sort of permanent long-term tariffs on things like pharmaceuticals. It's already underway on semiconductors. It could be launched on entire nations, just like it was on China. My short list includes India, but potentially also the EU as they continue to not meet the president where he wants to be, and you can question where the president wants to go. But the bottom line is that we are entering into a more uncertain phase as we get through the very specific components of trade law and they implement tariffs via different routes.
Henrietta, any idea of where the Supreme Court leans in terms of limiting or not presidential power here?
That's way above my pay grade, except for that they didn't try to limit the president's ability to determine what does and does not constitute an international economic emergency. The courts last week didn't say, fentanyl isn't a problem. They said IEEPA doesn't give the president the authority to impose these tariffs. And they upheld it unanimously. Those were judges across many different administrations. And I'm wondering whether the Supreme Court sides with them here. It's definitely a fraught question, but we just immediately should pivot to the Balance of Payments Authority, Section 301, Section 232. There's no sleep here.
Do you think investors are not really accounting for a potential re-escalation here? There are a lot of investors who will go out there and say, well, Liberation Day was kind of the strictest of measures that we'll see, but now are they accounting for what the new worst-case scenario looks like?
That's a great question, Sonali. What I have noticed is that it's not necessarily the macro guys who are focused on it. I spend a lot of my time with PMs or chief economists and things like that. What's happening now is that it's sector-specific analysts focused on pharmaceuticals, specific tax strategies happening in Ireland. Those guys really have to get up to speed because if we do pursue tariffs via sectoral 232, 201, 301 approaches, you got to know every single thing about how long those tariffs can last, what the comment period is, when the hearings are, all those pieces. So it's really becoming more sector focused as opposed to, what's the global effective tariff rate, which is not a relevant question in my opinion.
Henrietta, great having you on. Always appreciate your intel. Henrietta Treyz there from Veda Partners. Coming up later today, by the way, Ian Bremmer of the Eurasia Group weighs in on the rising geopolitical risks. That's at 3 p.m. New York time on The Close. This is Open Interest.
Let's got to check on these markets because the S&P 500 is right under that 5,900 level. We are off of session lows, actually closer to session highs, but still down about 0.2% on the day. That NASDAQ 100 has been trying to flirt with green territory all day, helped by NVIDIA, not helped by Tesla. But of course, also a close watch on the bond market here. Very wide range of views on whether investors are willing to get into the long end, given the fiscal concerns with the United States. But of course, we had weak economic data this morning, manufacturing data that did drive at least the short end yield lower, Matt.
Yeah, I think it's really interesting. Great story on the terminal about the long end
Buyer
and how a buyer strike at Double Line, at PIMCO, at Trust Company of the West, et cetera. So highly recommend reading that. Let's look ahead to what's coming up this week. At 1 p.m., Fed Chair Jerome Powell gives opening remarks at the International Finance Division's 75th anniversary conference. We're going to hear from more Fed officials throughout the week, including Goolsbee, Logan, and Bostic. The Bloomberg Tech Conference kicks off on Wednesday in San Francisco, so watch for headlines from that. Earnings reports are expected from companies. Wow, there's still earnings reports?
It sure is. It's
Are we
always
not
earnings
done?
season.
Broadcom, Dollar Tree, and Lululemon. Thursday brings the ECB policy decision. That's the European Central Bank. And then the big event of the week comes on Friday, when the all-important jobs report is expected to show that the pace of hiring slowed in May. Coming up tomorrow, we have Gargi Chowdhury, Cliff Asness, and Bruce Richards. This is Open Interest.